2 hours into the trading day, it's time for Yahoo Finance's Market Minute. Stocks are surging after the U.S. and China agreed to temporarily reduce tariffs amid negotiations for a final trade deal. Magnificent Seven names Amazon, Apple, Nvidia, and Meta rallying off the tariff news. Meantime, retailers also getting a boost from progress on those negotiations. Nike, Lululemon, and Target all rising. Notable, the de minimis exemption, which allowed packages below a certain value to be imported tax-free, does not appear to be part of the U.S.-China truce. That could still be a headwind for so-called fast fashion retailers going forward. Energy soaring after agreeing to buy a fleet of natural gas-fired power plants from LS Power Equity Advisors for $12 billion. This is a bet the fuel will be critical to meet electricity demand from data centers. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, stocks are rallying off the back of U.S.-China trade talks. The nation's agreeing to temporarily cut tariffs amid negotiations. We'll talk about how to play the rally today. And Generational Wealth Playbook all week long will be your guidebook for transferring wealth from the initial tricky conversations to the paperwork behind gifting stock and even real estate. We'll take you through the details that you need to know. Plus, savings strategies. Once you tackle the basics, it's time to jump on more advanced strategies we'll discuss with a personal finance expert. We've got all that and much more coming up over the course of today's show. But first, let's begin as we always do, taking a look at some of the market action 90 minutes into the trading day. Stocks soaring today as the U.S. and China agree to temporarily reduce tariffs. Joining me now, we've got Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager. Burns, you see a stock rally like this coming after some of the weekend trade talks that we were all anticipating to take place. How should investors be looking at the market right now?
Thank you, Brad. I appreciate y'all having me. And, really today's market reaction is the perfect example of what matters is not necessarily what policy is or what you find out in the markets, but what happens relative to what is priced in. And, we've seen a gradual de-escalation of the trade war over the last 3 or 4 weeks. And I think there was some expectation of a deal with China to kind of pull back from the brink even more. But what we did find over the weekend was that the president, in fact, did rein in the tariffs on China even more than was expected. And as such, like the markets are reacting positively to that. I think really what the markets like to see is they like a renewed certainty, and they like the fact that you're really there's a demonstration that if the economic pain or if the stock market pain gets too bad, the president will in fact pull back from any of his larger threats. If there's anything that we still have a little bit of concern about, it's the fact that if you go back a little over a month ago, our worst case scenario for tariffs was 10% tariffs across the board. And as of today, even with the agreement in China, that 10% across the board is now probably the best case for tariffs. And yet the market is now actually up from where it was prior to April 2nd. And so, in many ways, I think the stock market is kind of looking above and beyond any of the risks.
And so, as we await some more of the details, because that's truly what is going to impact some of the businesses, the companies that have tried to have the ear of the president, what is the checklist for those details to really kind of bake into your own portfolio strategy?
Yeah, I think that the signposts that we look for, and bear in mind, this is simply it's punting. We're getting 3 months reprieve for negotiations to have a framework for negotiations. But it does appear that at least in the interim time, that China is going to be facing the same 10% tariffs that the UK does, and ultimately it appears that China tariffs will probably settle out at around 30 to 35%. That said, when you factor that in, plus the 10% across the board tariffs, this still amounts to one of the largest tax increases in history. And so really, the most important signpost we have is the fact that this 3-month period does give the administration time to negotiate and work on a tax cut to help offset those tariffs. In many ways, this is a bit of a reversal from what we saw during the first term, where you saw large tax cuts, significant deregulation, and then they kind of use that to get through some smaller tariffs. And in this case, we've seen a bit of the opposite, whereas the tariffs have been large, and now we're actually going for the tax cuts. And so that's really the place to keep an eye on.
And so, Burns, a lot of questions out there. A lot of investors might be just pondering, okay, so what next? U.S.-China was the biggest deal that a lot of investors were really looking across, and we don't have a firm deal yet, but we do at least have people coming to the table, reducing some of the 100% plus tariffs that were on the table so that they can have those discussions over the next 90-day period. But for investors trying to figure out, all right, what next from here? What should they then be doing with their own portfolio? How should they be trading amid what many large institutions are still anticipating to be some of the heightened volatility?
Well, I think that the place to look at any point in time is to find areas that are out of favor, or areas where the broader stock market has overreacted. And one place, and this is probably a bit of an out of favor view, but given the fact that recession risks, or at least the perception of recession risks, really escalated as a result of the trade war, a lot of the cyclicals have started to kind of come into our wheelhouse and look cheap again. And the consumer has remained a workhorse. You still have unemployment around 4%. Inflation is pulling back, and you do still have a Fed that is broadly in easing mode. And so some of the cyclical areas, places like industrials that have kind of gone a long way towards pricing in a recession, might be kind of a way of kind of zagging when the market zigging when the market zags.
Burns, thanks so much for joining us here. Really appreciate it.
Thanks for having me.
We're set to get a fresh look at the state of the consumer this week. Yahoo Finance's Josh Lipton is here with us now on more on what we can expect here. Josh, what are we watching for?
That's right, Brad. So investors, we know, always eager for more insight into the health and resilience of the American consumer. And this week, they will get more important data on that front, including Walmart's first quarter earnings. We've got retail sales and University of Michigan consumer sentiment. So what has been the state of the consumer as we head now into these reports? Well, the Bank of America Institute says consumers continue to show moderate spending momentum, with most being in good financial health. April card spending per household was up 1% year over year. That follows a 1.1% rise in March, according to Bank of America aggregated credit and debit card data. They say the financial position of most consumers appears sound. Now check out the XLY, that's the consumer discretionary ETF. It is down about 5% this year, but it's up around 20% now from that April 8th low. The Telsey Advisory Group, a consulting brokerage firm focused on the consumer sector, says a barbell approach to the consumer does make sense, given that lower to middle income consumers face more challenges and will need to stretch their dollars in spending on basics, while the upper income consumer, they argue, has the means to continue spending on goods and services. In the apparel and footwear category, they are fans of Birkenstock. As for consumer technology plays, it's Amazon and Warby Parker. For department stores, Burlington, and among the discounters and supermarkets, they tell their clients Costco and Walmart remain top picks, Brad.
All right, we're going to be watching for this closely here. Thanks so much for
got it.
lining this up for us, Josh. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. The median list price for new builds fell again during the first quarter, according to a new report from Realtor.com. Here to discuss, we've got Joel Berner, who is the chief economist at Realtor.com. Joel, great to have you here with us. Let's focus first on prices for new homes. What contributed to the decline in new median prices this quarter?
Well, the biggest thing, Brad, is that builders are building smaller and more affordable homes in a lot of the U.S. metros. In 26 out of the 100 largest metros across the country, the median price and the median square footage of newly built homes fell on a year-over-year basis. So while a lot of home buyers are looking around for a home that meets their needs and seeing that the existing home market just doesn't have anything in their price range, builders are delivering new inventory that fits that price consideration really well.
And so in the first quarter, existing home prices actually increased on a year-over-year basis, though they're still cheaper than new builds. What does that mean for buyers, and how is that influencing the decision-making process?
I think buyers are going to see that even though there are a lot more homes on the market right now, especially in the existing home space, with people starting to list homes that have been reluctant to in recent years, the buyers are still going to see price challenges on the market. The existing homes continue to increase in value, which is a great thing for homeowners, but difficult for first-time home buyers especially. So what we're seeing instead is that builders are offering the choices for prospective first-time home buyers that meet their budgets better than the existing home market does.
Is there a material difference for mortgage rates between new home buyers versus those who purchase an existing home?
There is actually. Not only do new home buyers save on the cost of home ownership because there's less maintenance to do on a new home, but we see that they pay about 0.5 percentage point lower mortgage rate than existing home buyers. It's about 6.6 to 6.1 in 2024. And that's really interesting because what a lot of home builders are doing is offering mortgage rate buy downs as an incentive to close the deal. So builders or buyers of new homes can save on their financing as well as cost of home ownership by locking in these lower mortgage rates.
So tell us more about how tariffs could potentially impact the price and just the psychology around some of the new home builds.
Yeah, I think you're exactly right, Brad. There's two pieces to this. There's the direct effects on new builds. There's a 14% lumber on Canadian, or 14% tariff on Canadian lumber right now that's set to go up to 34% this fall, and that will simply add to the cost of a new home. That will bring housing prices up pretty directly, and not a whole lot of question as to the direction of the impact there. But where tariffs are a little more confusing and more interesting, I think, is in consumer sentiment. We've been talking a lot about it for months now as consumers are looking at the stock market, which has looked good in the last week or so as trade wars have kind of been walked down a little bit, but continues to be a little bit rocky, and as well as considering their own financial situation and their own employment situation, which tariffs are going to jeopardize. Because, you know, the only thing that really pins up the housing market is the labor market. So if people are afraid of losing their jobs, it's going to impact the housing market. It's going to bring down housing values and going to slow home sales even more than they already have been.
Wow. Okay. And so as you're reading through the employment situation and the labor market more broadly here, what are your kind of best anticipations around what that could signal for the home market for the rest of this year?
Yeah, it really depends if these tariff effects are going to be felt in the labor market statistics that come out already or not. I think there's a lot of uncertainty in the market. There has been over the last couple months, and that could drive companies to slow down their hiring, could lead companies to start layoffs. It could have a negative impact on the labor market. But if this was really all just posturing and we're kind of pulling back from some of these extremely high tariffs that had been put in place and now settling somewhere a little bit more manageable, then we might get through this tariff situation without a major impact to the labor market, which is what we're all hoping for.
With that in mind, we have a Fed that is very data dependent and has signaled that it's not going to be too quick to move on rates unless the data is specifically spelling that out. You're shaking your head. What's going through your mind as you hear the comments from Fed Chair Jay Powell and the committee?
Yeah, I think the Fed's doing the right thing. They're not going to overreact, not to 1 month of data, not to one policy decision. They're going to move slowly and take this as a whole picture. And I know that some people, some very prominent people, are a little bit critical of the pace at which the Fed decides to move. But until we get more information about how all of this economic activity is making its way into everyday Americans' lives, it would be foolish to make large, drastic decisions before plenty of data has come in and we're seeing how the labor market has really shaken out.
Yes, that one prominent figure, I believe, calling Fed Chair Jay Powell a, quote, fool. And we will continue to see how Fed Chair Jay Powell just continues to navigate, perhaps keep his blinders and the team around him focused on the mission here. Joel, thanks so much for the context and the insights. Appreciate it.
Thank you, Brad.
We've got new data from the National Association of Realtors revealing the vast majority of metro areas registered price increases for existing home sales in the first quarter of the year. Here with the details, we've got senior housing reporter Claire Boston. Claire, what do we know on this?
Hi, Brad. So you are right. In 83% of measured metro areas, home prices increased in the first quarter. Once again, this is the latest sign that affordability in this country is very, very challenged. But, you know, that was actually a little bit of a smaller amount of counties seeing an increase than the prior quarter when it was 89%. So, you know, maybe things are getting a little bit easier. And then nationwide, we saw a 3.4% increase from a year ago. That brings the average home in this country to over $400,000.
Now, there's another story you're watching as well. A city here particularly here, as we're thinking about what is taking place within the city and the population of just over 200,000, one of the toughest housing markets in the U.S. this spring. So where is it and why is there such tough competition?
Right, it's a little counterintuitive, but one of the toughest housing markets in the country right now is Rochester, New York, upstate New York, 200,000 people, about 1 million people in the metro area. And yet home prices there are up 12%. The average time on market is 8 days. I talked to a bunch of people who have experienced this market and they say competition is extremely intense. And what we're seeing in Rochester and some other cities is basically these are cities that are catching up to national home prices. It is still really affordable to live there. In Rochester, the average home costs about $225,000. And as a result, the competition for those homes is steep. They're also not building very much. And then going back to the NAR data, you know, I was looking, some of the biggest home price increases were happening in places like Syracuse, New York, and Montgomery, Alabama. And those are also towns that I think are pretty similar to Rochester in that, you know, overall, they are still relatively affordable places to live. And that makes competition harder than ever in those markets.
Claire, thanks so much for breaking this down. It's going to be interesting to watch those dynamics in Rochester.
We'll see.
Yeah. Now time for some of today's trending tickers. We are watching Target, Astera Labs, and Kindly MD. First up, Target downgraded to underperform from market perform at Bernstein. The analyst says that the retailer faces a difficult trade-off between fueling sales growth and maintaining margins. Bernstein says Target is losing market share in core discretionary categories like home and apparel, and that e-commerce growth could be a persistent margin headwind for Target. The analyst says poor weather, weak consumer sentiment, and a DEI-related strike in March weighed on first quarter results, and that tariff risks aren't fully priced in. Next up here, we've got Astera Labs getting an upgrade to overweight at Morgan Stanley. This is following the chip manufacturing company's quarterly results. The firm says recent weakness in the stock represents a good entry point despite the stock being, quote, highly polarizing. The analyst cites AI optimism, saying they believe there is too much pessimism in AI and says new products should give the company sustained growth. And finally here, healthcare services company Kindly MD surging the most on record on an agreement to merge with Bitcoin holding company Nakamoto Holdings to start a Bitcoin treasury strategy here. Nakamoto was founded by David Bailey, a crypto advisor to President Trump, and the merger includes $510 million in private investment, $200 million in convertible notes. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Let's get a check of the markets, everyone, as we're taking a look at some of the major averages here on the day, still holding on to some handed gains right now by about 2.2%. There's handedly higher here on the day. The NASDAQ composite, that's off of its session highs, but still, hey, we've been in that territory, in that ballpark, just kind of hovering around 3.4% in gains on today's activity. The S&P 500, that too, hovering around 2.5% in gains on the day. Let's actually put this in a little bit of a longer context, year to date perhaps here, because I was taking a look at some of the price action correlation around when we first started hearing President Trump after the inauguration talking about what some of the tariff policy or even some of the actions that the administration was looking to set off in late February and early March. And some of those Truth Social posts here, as I was correlating it back to this early first week of March, kind of late February when we started to hear it teased about, this is where the markets are going to see that next critical test here, because as you're taking a look at the levels that we still have to usurp, even though we've taken out the losses since the Liberation Day announcements for tariffs, now the next big test is, oh yeah, the pullback that we were already starting to see even prior to, and especially in some of the larger names. Think about NVIDIA, think about Apple here. And so two of those names that had actually led the market lower to start off the year, taking a look at some of that year-to-date activity, we still got a ways to go here. For Apple, AAPL, that's down 16.7% year to date. And some of those declines had already started to happen even prior to the rest of the market downturn and prior to some of the Liberation Day comments. NVIDIA was the same case there. NVIDIA going into some of those announcements, I believe at some point was down by about 8%. Again, still, they had come off of the highs, but you go into that announcement and you still had some of the declines even prior to some of the posts starting to emerge here. As of here and now, as Luther Vandross would say, NVIDIA is up 4.4% on the day. Year to date, still down 9%, so still got some area to claw back there. Apple is up by about 5.25% here on the day. We mentioned that year-to-date move. Mega cap tech stocks certainly catching a bid here on today's activity. Amazon, perhaps a sigh of relief there that some of the products, of course, that go into their e-commerce platform, depending upon where they are sourced from around the world, that could alleviate some pressures if we do see the trade talks continue in a favorable manner. That would benefit Amazon here. And interestingly here, Netflix pulling back. One of the few names, at least scattered names, that is pulling back within the NASDAQ 100 today. And this has often been seen in recent weeks as one of the most insulated plays. You're less likely to cut that subscription, and Netflix is continuing to tout some of the subscriber growth metrics here. So over the course of the year-to-date scale, bucking the wider trend, it's up by about 24%, but still here today, pulling back just a little bit by about 2.75%. So we'll continue to track all those moves here. A lot of time left in the trading day. Well, stocks are surging today after the U.S. and China agreed to temporarily lower tariffs for 90 days as they work out a final trade deal. We want to talk about how investors should think about the rally within their portfolio. Here with more, we've got Preston Cherry, Concurrent Wealth Management founder and wealth advisor. Preston, good to have you on the program with us. So what do you do with a day like today, coming off of a Sunday two-day meeting concluding here where you have some easing in the pressures for both sides and hopefully some of the cooler heads prevail?
Absolutely. I think you just continue your contributions over time. So investors have a little bit more confidence now with the trade announcement. And nobody likes hearing more of the same during corrections or crashes, but more of the same is good for rallies. So continuing contributions during a rally helps dollar cost averaging. So business owners with paychecks and also professionals with paychecks continues that investing over time and buys at highs and low points and smoothing out that price, that cost basis over time.
What's the number one question that you receive from clients when things are rosy, bright, versus when things are a little bit more tumultuous, unpredictable, perhaps, and they're trying to figure out, okay, what should I be doing with my own portfolio strategy at this juncture?
Yeah, sure. So when times are bad, the question is, should we go to cash? And when times are good, is should we hold our cash and wait for the next correction or crash? So it's all surrounding around cash, and cash is good for emergencies, liquidity purposes, lifestyle choices, and during times of uncertainty. That said, cash doesn't earn the market return, historical market returns. Inflation eats up that cash. And if you continue to stay invested, then you can capture the best performing days historically after low historically performing days.
With all of this in mind, are you too late if stocks are already rallying on a day like today?
The worst behavioral finance behavior is FOMO, so fear of missing out. Actually, last year, there were 57 new highs in the market. So this question came up often. Do we hold our cash and wait for the next crash? Well, with 57 new highs, last year, there were 62 new market highs in 2017. So when the market has good momentum and there's not as much uncertainty in the market and the economy, then the market historically tends to keep the momentum and go higher.
And so with that in mind, how do you kind of best gauge what your exposure should be coming out of, or even in the midst of times where the markets are more volatile, and how you start to selectively pick areas where for the long term you feel comfortable being invested in?
Yes, folks should always consider their risk capacity, their risk tolerance, and their goals, and have an intentional investing plan in order to help them maintain that good investing behavior. And also, too, there's opportunities in the market. For example, we're looking at Delta. Delta is consumer discretionary during times of uncertainty. Then folks are looking at their pockets. They're going to pull back their travel budgets. And Delta did not list any guidance in their last call. And their stock went down about 25+%. Now you have new tariff announcements on the positive side, and folks are saying, I have a little bit more confidence to re-engage with my budgets, and now Delta is up 25, 27%.
Preston, as best indicator as it has been for risk on sentiment, Bitcoin is back in the ballpark of some of its highs here. So what should investors do with that information if they're trying to figure out what the broader sentiment, what the bullish or animal spirits are that might prevail in the equities market?
Yes, with Bitcoin, cryptocurrency as a whole, folks call that decentralized finance and the market's traditional finance. And usually, or nowadays, they're acting kind of the same. So with the crypto coin investors, they have more of a belief system in that particular structure, which is different from, say, printing money, so to speak. That said, there's a lot of correlation there in those two areas. However, in the Bitcoin and crypto space in general, lots of volatility. So peel off a small portion of your overall portfolio, say 5, 7, 10%, in order to gain exposure to those volatile areas if it fits your risk capacity and goals, and invest that way, not your whole entire portfolio.
Preston, just lastly, while we have you, we have two companies that could be bellwethers, both for the consumer and Walmart's capacity, and then for the semiconductor trade in NVIDIA. And neither one of them has reported yet. We're going to hear from Walmart, and then later on in May, we're going to hear from NVIDIA. What are your anticipations for what these two earnings bellwethers could signal to the markets?
I think Walmart is a steady as they go type of company, particularly when you have uncertainty and lack of confidence in the overall market. We have political risk, we have economic risk with the trade on and off. So folks are going to be watching their spending plans over time, and people are trading or swapping out their Target visits or higher income grocery store or consumer needs and wants to more bargain elements like Walmart. So I think Walmart will stay consistent with higher foot traffic. And NVIDIA, when those type of companies have those innovative mindsets and also moats around them, protective moats, have good cash flow. So when the market has a little bit more confidence in there, then I expect those companies like NVIDIA to rally.
Preston, great to see you again. Thanks so much for taking the time here with us.
I appreciate it. Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Financial consultants predict that older Americans will pass on $124 trillion in assets to their heirs over the next 2 decades. But let's face it, talking about money can be uncomfortable. That's why we've got a few tips to help make those conversations a little easier. Joining me now, we've got Tom Deans, author of The Happy Inheritor. Tom, great to have you here with us. Let's just start there. How can families begin the conversation about inheritance and wealth transfer without creating tension or discomfort?
Well, Brad, it's a great place to dive into a complex subject. I mean, we got, you quoted that number there. It's roughly $300 billion a day. I mean, it's a staggering amount of wealth that is transitioning between the generations, most of it chaotically. We have 137 million American adults without a will. I mean, the most important document in an estate plan is missing roughly in half of all American adults. It's not good, Brad. So we know why. It is an uncomfortable subject. It's awkward. Culturally, parents don't really want to talk to their children about, what they're going to inherit, what the kids are going to inherit, because that kind of feels like I don't know, they're setting their kids up to receive a windfall and they don't want to take away their drive and ambition. And of course, kids don't know how to, children don't know how to start this conversation with their parents. It feels awkward or like they're clamoring for stuff. So often the result is silence, right? Parents and children find this kind of awkward ambivalence around this important subject called money. So my advice is really straightforward. It's, first of all, I think when children can actually get their own, when I say children, anyone over 18 needs a will. Nothing says we die in order. So I say to young adults all the time, if your parents aren't talking about this stuff, you can get your own will done and give your own will to your parents. You can maybe say, listen, I'm gonna be on a flight, I'm gonna be traveling. Nothing says we die in order. You should have my estate planning documents. Most parents will think, well, that's kind of weird, but you're kind of parenting us. When children parent their parents on an awkward subject like estate planning, many parents will reciprocate. There's that kind of reciprocity, and that may be the trigger that causes them to kind of, pass on their documents and start a family conversation. It's really, really important. Alternatively, Brad, I would suggest that parents can say, listen, we'd like to talk about our long-term care.
Right.
So before we talk about who gets what, in our estate, we'd also like to talk about our long-term care and who in the family is going to oversee our care. The two subjects are really intertwined.
So at what age should you have the wealth transfer talk with your kids? And I like the strategy that you mentioned up front, which is, say your kids are old enough to have their own planning and, put that in front of their parents. But, what if your kids are not old enough to have that planning started up? So you're trying to figure out now as a parent when you begin kind of the familial conversation with your younger kids.
Well, this answer may shock you, Brad, but I think the age is 5. At 5 years old,
wow,
children are capable of understanding basic money concepts. They are not going to understand anything in detail, but they can be introduced to the idea of wealth and how it's earned versus gifting, general concepts, basic concepts. And as those children get older and older and older, then the level of detail that is shared can be comprehended slowly and absorbed. I think people want to go from 0 to 100 miles an hour when it comes to money and teach everyone all in one moment in time. The reality is that moment rarely comes, and most adult children are left in the dark. It's why most wills in this country are revealed when someone dies, which is way too late to teach people about, the power of compounding interest and the importance of saving early on and investing early on. All of these concepts can be taught at a young age, as young as 5.
So what are some things that parents should make sure to discuss with their children when it does come to transferring their wealth?
Well, I think, first of all, you absolutely need to, and this again is counterintuitive, but it is this idea of sharing your estate planning documents is absolutely crucial. 137 million Americans without a will, there is no estate plan. And to leave that conversation right to the very end, when someone dies, it's not just people learning about what they get. It's finding the backup documents that go, the title, the deeds to land, to real estate, insurance policies. It is staggering the amount of questions that start getting fired when someone dies. Of course, it's too late. Those conversations are irretrievable. So it's not just enough to do estate planning. It's important to get your family to participate in those conversations before you draft those documents. In other words, draft the documents with their input and then go one step further and share those documents so that the people who are named as beneficiaries will be prepared. Mm-hmm. I mean, really, my book, The Happy Inheritor, is really about preparing heirs for the smooth, calm transition of wealth.
Yeah.
It's an enormously complex subject that requires time and effort.
What are the 3 questions that kids should ask their parents about their wealth?
Well, I think the obvious one is, who have you selected as executor? The children will be dealing with the executor. If it's not a family member, then it's going to be someone who's been appointed, a public trustee, and it would be really great for family to know who that is. It would be even better if the family participated in those conversations to help help make better, more informed decisions. That would be number one. I think number two would be to have a really good list of assets. What do you own? Where is it? The wealthier you are, the more stuff you've accumulated. In many cases, it's assets that are located in other countries. Getting that list of assets, setting the executor and the family up to succeed with the administration of those estates is absolutely crucial.
Tom.
And then,
yeah.
And then third, I'd say share your wills.
Yeah.
Right? Like share your will, your healthcare, your power of attorney for finance, and your healthcare power of attorney. All those three documents are crucial so that people can be empowered to serve that family member who is aging and ultimately going to die.
Tom, thanks so much for taking the time here with us today. Really important conversation and hopefully a lot of helpful tools there for families to begin these discussions. Appreciate the time.
You're welcome, Brad.
If you have credit cards with high interest rates and credit card debt, a 0% APR card could help pay off that debt. Yahoo Finance reporter Madison Mills explains how a balance transfer card with a 0% annual percentage introductory rate could help save you some money.
If you're struggling to pay off credit card debt, 0 APR cards could help you. The card has a 0 APR annual percentage rate introductory offer. That means you don't pay interest on the balance you transfer for a set period of time. If you didn't pay any interest on that debt for more than a year, could you pay it off? The best 0 APR credit card for you depends on your current balance, the length of the 0% APR intro period, balance transfer fee, and how much you can pay each month. For context, a recent study shows the average credit card debt is more than $6,500, and 0% APR introductory periods range from about a year to 21 months. So let's do the math. Say you have a $6,500 credit card balance on a 21% APR card. If you make only the minimum payment starting at $178.75 the first month, you would pay more than $10,000 in interest over more than 25 years before you can pay off your full balance. Now let's compare. Say you transfer your $6,500 credit card debt to a new card that has an 18-month 0% introductory APR and a 3% balance transfer fee. If you pay at least $361 each month toward that credit card bill, you could pay your balance in full in 18 months without any additional interest. You would still have to add in the 3% balance transfer fee of $195, bringing your total to $6,695. On a 21% APR card, your total more than $17,000. Be aware there are ways you can get in trouble here. If you transfer a balance to a 0% APR card and keep using the old card, making only minimum payments, you can run up your debt. If you can't pay off the full balance here on the new card before the intro period ends, you will need to pay the card's standard interest rate on the remainder. And that interest rate is typically high. Using a 0 APR balance transfer credit card can be a savvy financial move as long as you can commit to paying down that credit card debt. Scan the QR code for more information on the best 0 APR credit cards.
Rewards cards can be another tool to help you maximize credit card perks. Scan the QR code for our personal finance team's credit card picks. You can see which specific cards could be a good fit for you. Coming up, we've got much more wealth on the other side of the break. You're watching Yahoo Finance. According to Pew Research, about half of Americans have an emergency fund that can cover 3 months of expenses. But once you start saving every month, what should you do next? I want to bring in Bobby Rebel, who is the cardrates.com certified financial planner and personal finance expert, as part of our savings series brought to you by Synchrony. Great to see you, Bobby. So let's dive into this right now. How can you take action to make sure you're saving as much as possible?
Well, first of all, thank you so much, Brad, for having me. And taking action is exactly where we want to be because we have to be proactive. It's not going to just happen by itself. And one of the best things we can do is set very specific goals by separating our savings goals. You mentioned an emergency fund. That, of course, is the priority. I thought that statistic was actually better than I would have expected. So kudos to the people that are saving already. But separate. You want to have your emergency fund. You want to have your vacation fund. You want to have your retirement funds, whatever it may be, and make sure that you're you're separating them to make it more realistic and more tangible. You also want to track your spending backwards. And what that means is by putting your savings first, you prioritize that and you say, that's the way I'm really going to give to myself. The way to get there, use the right tools. Obviously, traditional budgeting apps are a smart way to go, but even AI tools can be really productive when it comes to putting our savings first. Throw it into ChatGPT. If you can't figure out where to get that extra savings, throw in what's going on in your personal situation. You might be surprised. Some good ideas could really come out of it.
How do you approach setting a savings goal?
So you want to really focus on what matters most to you. Be intentional, be thoughtful, be proactive, as I mentioned, and also, of course, take specific steps. You might want to, as the graphic that just went away mentioned, do things like stopping automatic renewals on subscriptions, because that way you aren't just mindlessly paying for things that you may or may not be using. I promise you they will come back to you to renew many times, often with better offers. And also make it a little bit harder to spend that money by removing your credit card information from your computer. So you have to actually physically get up, go get the number, re-input it. I can't tell you how many times I just haven't bothered, or I got distracted with something else and it just didn't happen and I forgot to buy that thing, and I guess that money can go into savings.
Yeah, I might have to Men in Black flashy thinking myself in the mirror just to make sure that I could forget those numbers, because I just remember them all. So what do you do if you get an unexpected windfall, whether your tax refund or an inheritance or even a bonus check from work?
Don't we wish this would happen to us? Yes, 'tis the season of the tax refund, I hope, for many of us, although we don't want too big a refund because that means we misestimated our taxes. That's a different segment. But I want everyone to respect the money by saving it. And again, making that a priority. A good goal, if you want a random number, is 50%. Obviously, 100% is the ideal, but the most important thing is to avoid lifestyle creep. Sometimes we tend to say, well, now we're making more money, or I got this bonus this year, I'm sure I'll get it next year, so now I'm going to live a little bit larger than I was previously. Don't do that. Stay true to yourself. You've been doing just fine as it is, and enjoy the bonus by rewarding yourself and saving it.
So how can you reframe your savings mindset?
I love this. What you want to do is really think of it as a reward to yourself. Very often our friends, and they're well-meaning, will say, oh, we're all going out this night. What are you doing? Are you going to buy a new outfit? You deserve a new outfit. This has happened to me so many times. And I think to myself, well, instead of spending this amount of money on a new outfit, maybe if I have the money, I can put it into my savings account and put it towards, the next vacation I want. Think of it as an investment in your financial freedom for the future. I love to set up mood boards. You can even do this digitally and picture where that money's going to go in the future. And it can be the way future. It can be your retirement. It doesn't have to be buying something or splurging on something.
Bobby, thanks so much for taking the time here with us today. Really appreciate the time and insights.
Thank you for having me.
Let's do a final check of the markets here. As we're approaching noon Eastern time, the Dow, the S&P 500, and the NASDAQ all rallying here today, following some of the trade talks between the U.S. and China over the weekend here. We're taking a look at the Dow up 2%, the S&P 500 up by about 2.5%, and the NASDAQ composite up by about 3.5% right now. We'll continue to track some of the market movements with the back half of today's trading session, but that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. I've seen them both in office, so they're definitely here, and that's definitely coming your way at 3 p.m. Eastern Time. They'll count you down to and through the market close.